Hi everyone, welcome back to our channel. Last month, the Reserve Bank of New Zealand released a detailed information of the debt-to-income, which is called DTI ratio, restriction framework. Although it is not yet to confirm whether or when it will be implemented. Once this restriction tool takes effect, it will greatly limit the borrowing capacity of property investors. Therefore, it is necessary for us to understand this policy early on and make appropriate preparations. Firstly, we need to understand what DTI is. DTI refers to a ratio of debt to income and is a tool used by the central bank to regulate financial risks and maintain financial stability. For example, if the set of DTI multiplier is 7 and your annual household income is 120,000, then you can only borrow up to the 7 times of your income, which is 840,000. If you already have a loan of 500,000, then the additional amount you can borrow will be only 340,000. Of course, this is a simplified example, and the specific multiples, income, and cost definition needs further policy refinements. Firstly, from this example, it can be seen that the DTI restrictions will be greatly limited the amount you can borrow again, thereby affecting your investment plans. To cope with this impact, we can take immediate action and purchase the property you plan to buy as soon as possible, with the interest rate currently having a little room for significant increases. People's concerns about rising interest rate have diminished, coupled with an increase in net migration and relaxation of the LVR ratio limit. The real estate markets may start to pick up. Now is a good opportunity to buy a property and effectively avoid the further restriction on your loans due to DTI. Secondly, if you already have a loan and own 2 or more properties mortgaged with the same bank, and plan to sell one of them in the future, the implementation of DTI is likely to require you to use the entire sales proceeds to repay the loan and not to be able to retain any cash. For example, suppose you have 2 properties with the loans of 300,000 and 500,000, respectively at Bank A. When you plan to sell the property with a loan of 300,000, the bank will reassess your borrowing capacity based on the current policy. Due to the new requirement of the DTI, your borrowing capacity is only 200,000. Then, after selling the property, you not only need to repay the $300,000 loan for the property, but also repay the $300,000 from the $500,000 loan until it does not exceed your existing borrowing capacity of $200,000. Many people may not be aware of this. Therefore, we need to separate the property mortgage together as soon as possible. When multiple properties are mortgaged to the same bank, the loans are treated as a whole. When you sell a property, the bank will reassess the amount of loan you can retain. If the requirements cannot be met, such as being restricted by the DTI, you may be required to use the entire sales proceeds to repay the loan without being able to retain any cash. Separating the properties also have another advantage, which is no longer being limited to the loan restrictions for a single bank, and you can consider options from other banks as well. Furthermore, if your current loan is on interest-only repayment basis and you plan to extend the interest-only period, it may not be possible to extend it after the implementation of DTI. As we mentioned in a previous video, the extension of interest-only loan is subject to reassessment. Once the DTI policy is implemented, it may be more difficult to extend the period. It is possible to apply for an extension under the current policy. It is advisable to apply for a 5 interest-only loan now to ensure the cash flow in the coming years. It is especially important in the context of rising interest rate and living expenses, where the significance of interest-only repayments to cash flow is self-evident. In summary, we recommend consulting your mortgage advisor as soon as possible, or contacting us to help you to analyze and provide you the most professional loan advice. Missing the opportunity to improve your loan structure now may mean missing it altogether. We hope today's content has been giving you some helpful insight, and we will provide you a specific advice based on your situation. If you need our assistance, please feel free to call us and let us to conduct a comprehensive review for you. Have a great day and see you next time.